Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, futures pointing to a higher open, the risk-off trade reversing as oil prices pair some gains here. Overnight, WTI crude traded above $77 a barrel. Investors keeping a close eye on the escalating missile attacks between Israel and Iran, which are now in their fourth day. Both sides widening their attacks overnight, Israel saying it has now taken control of the airspace above Tehran and the western part of Iran. Meantime, Tehran striking an oil refinery and damaged part of the power grid. While tensions rise in the Middle East, G7 leaders, they are set to meet this week in Canada, where issues from geopolitical tensions to trade and the global economy will be at the forefront. The meetings this week come amid a busy week for central banks around the world. Central banks in Japan, several European countries, and the U.S. all holding meetings. And the Federal Reserve decision is Wednesday, and investors are going to be watching closely for the latest economic projections when the dot plot is released. And the deal between U.S. Steel and Nippon Steel finally approved. President Trump giving the green light over the weekend, and the U.S. government will have extraordinary power over the company, thanks to a golden share. A New York Times report says that the government will have veto power over important decisions that the company makes and sway over the company's board of directors. U.S. Steel shares are rising right now by 5% on the news. The FOMC's June rate decision coming Wednesday. Investors aren't expecting the Fed to cut rates, but they are awaiting an important update on the economic outlook. Yahoo Finance Fed correspondent Jennifer Schonberger has more. Jennifer.
Good morning, Brad. That's right. The Federal Reserve widely expected to hold interest rates steady when they conclude their policy meeting this Wednesday. But all eyes are on whether the Federal Reserve will remain committed to 2 rate cuts this year. The central bank has been holding rates steady in the range of 4.25% to 4.5% since December. And some former Fed officials say the central bank is unlikely to change that projection in light of so much policy uncertainty from the administration. The Fed is likely to remain in a holding pattern and reiterate that rates are well positioned to react to changes in the economy. Officials have stressed they're worried about higher inflation from tariffs, even as the past 2 inflation readings have been mild in the face of tariffs, as well as slower growth. And even as the latest jobs report showed the labor market is cooling, the unemployment rate remains historically low at 4.2%, as wages are growing at a nearly 4% clip, giving the Fed time to see which direction they think rates need to go. And while some expect few changes to the economic forecast, JP Morgan's Michael Ferroli says the Fed could increase its forecast for inflation as well as the unemployment rate by lowering its outlook for growth, giving more of a stagflationary whiff. In the weeks leading up to the meeting, while officials haven't said the risks to both sides of their dual mandate have changed, commentary has tilted towards fears for higher inflation rather than a job market that's cracking. Now, this has preceded tensions between Iran and Israel ratcheting up. JP Morgan's Ferroli and Deutsche Bank's Matt Luzetti are calling for only 1 rate cut this year. But former Kansas City Fed President Esther George tells me the Fed doesn't want to shake the markets and make people think they want to hold rates higher for longer when they're not ready to do that just yet. Of course, President Trump highly likely to criticize the Fed's decision to hold rates steady. He has been harping repeatedly on Fed Chair Jay Powell and the Fed to lower rates, citing other central banks around the world like the ECB, which has already cut 8 times. President Trump also telling Jay Powell in his first face-to-face meeting with the Fed chair earlier last month for the first time this term that he's making a mistake by not lowering rates now. Brad?
All right, we're going to continue to watch to see how Fed Chair Jerome Powell continues to kind of swerve, even giving some of those comments from the White House and President Trump even the semblance of acknowledgement, and ultimately what comes forward in those critical discussions, the 2-day meeting for the FOMC. Jennifer, thanks so much for setting up. Well, U.S. futures this morning, as we're taking a look at the Dow, the S&P 500, and the NASDAQ, they're holding on to some gains fractionally here. Risk appetite in the U.S. market improving slightly this morning. Investors closely watching the escalating tensions in the Middle East. Joining me now to discuss, we've got Callie Cox, who's the Ritholtz Wealth Management Chief Market Strategist, and Stephen Juneau, who is the BofA Securities Senior U.S. Economist. Great to have both of you here with us. So let's begin on the Middle East tension, and then we'll come back and we'll round off the conversation with the Fed and the meeting. But first, Callie, I wonder, as we have, and we, as Morningstar had put it in one of their recent notes, we tend to have this recency bias where we look back to previous events that give us the best kind of analog to compare how the market should react. Are we surprised at all by how the market is reacting, especially knowing that this is an environment where it seems like investors, traders were just latching on to more good news and then kind of fading or tapering some of the bad news more quickly?
I am not totally surprised by this. Geopolitical events, and they are very hard to talk about because centrally and deep down they are, humanitarian crises. So I want to keep that in mind.
Absolutely.
But geopolitical crises rarely affect the markets because many aren't truly a threat to the U.S. economy. I think the biggest threat here, Brad, is oil prices and the supply of oil. Iran doesn't trade oil with the U.S., but you have to think about oil in a systemic fashion and how oil prices moving up the most in 3 years on Friday, taking a little bit back of it now, could affect what we pay at the pump and could affect our expectations for inflation.
Stephen, in the most recent inflation readings last week, oil, gas, that was actually one of the bright spots in a retracement and a move lower, at least in the most recent reading. But how do events like this also find their way into some of those data prints in the future? And what should we be tracking up against?
Yeah, so you're going to see oil prices, if this persists, right? If crude prices remain at these levels and continue to move higher, that's obviously going to put upward pressure on energy prices at the pump. And then, of course, there might be some limited pass-through pressures to the core. So you're looking at a potential more stagflationary scenario out of that. Of course, this has to persist right now. And we're still at a point where oil prices are relatively low compared to, say, a year ago. So we'll just have to see how things unfold from here. I think it's too early to say.
And so, Callie, as you're thinking about a trading kind of mantra or mindset, even with so much of the conflict that is moving part on a daily basis, whether that is the two countries at hand in Israel and Iran, but also the U.S. response, what notably should investors be using kind of as their checklist to inform their own portfolio strategy around this time?
Well, it all depends on what kind of investor you are. I think you have to level set there. Are you trading for days or weeks ahead, or are you investing for years or decades ahead? If you're looking, years or decades down the road, as many Ritholtz clients are, you have to think about the impact to the economy and what this could ultimately mean for the trajectory of the U.S. economy and corporate earnings. And honestly, and it's a hard truth to swallow, this Israel-Iran conflict probably won't make much of a dent unless we see some major escalation. Again, the one thing you have to watch, and I think this is important for those traders looking over days and weeks, the important thing to watch is oil prices, because I think the stock market could be incredibly sensitive there, especially when you think on a sector level, when you have energy stocks that have been beaten down so much over the past year.
Yeah, we had Mark Ginsburg on, former ambassador, who made some of those very comments as well last week. As we are thinking about the exogenous threat specifically, he was speaking on that and the risk of the Strait of Hormuz, where that could be an escalation. But things look like they're passing through based on data that we've seen thus far in the early innings in the past 4 days here. As you were mentioning the economy, naturally, Stephen, that brings me to what the Fed is going to be looking across in the data points, the hard data that they're going to be evaluating at their meeting. And 50 basis points, it still seems like the market's trying to factor that in by the end of the year. What do you think is the kind of if this then that of their own calculation for us getting to 50 basis points?
Well, first, I think what we're going to see at the meeting is we get these updated projections, and we expect the Fed to go from 2 cuts this year to 1, and just acknowledge that the economy is holding up. When we look at the labor market data, it's been good. It's been stable. The labor market's not showing signs of significant deterioration. And then inflation's still above target, and they still expect inflation probably to move away from them. So we expect their inflation projections to move higher as they account for the tariff effect. Now, we didn't get that in the latest data, but I think this is what they're going to be watching most closely moving forward is how does the inflation data evolve? And then how does the labor market data evolve? If inflation moves away from the target and the labor market remains stable, then it's going to be difficult for the Fed to get 2 cuts in this year. We're in the camp that they don't manage to get any cuts in this year.
Kelly, where does the Fed rank among investor considerations from the talks that you're having and the strategy that you're rolling out?
We don't get many explicit questions about it, but frankly, it feeds into a lot of the indirect questions we get around interest rates, the future of the economy and the future of policy. I mean, you have to think about it. Interest rates affect how we think about money and what we do with it. Do we spend it? Do we save it? Do we invest it? I mean, if you're worried about mortgage rates, then implicitly you're probably a little worried about what the Fed does here, even though mortgage rates are priced on more of a long-term perspective. But I'm worried about what the Fed will do here. I think the fact that the Fed's hands are tied is something that should maybe keep you a little more cautious heading into the end of the year, especially if the labor market does break more. The inflation outlook too. Going back to the Israel-Iran conflict, that worries me, mainly because oil prices do feed into inflation expectations so much. And even though the Fed doesn't base policy on oil prices, it definitely bases policy on inflation expectations. And it's just an incredibly muddy outlook for them.
Yeah, and they have been wading through, as many corporate entities that you were mentioning earlier as well are trying to figure out what the tariff implications are that they need to consider and bake in to their own guidance and forecasts. Just to follow with you quickly, Callie, we know that based on a KeyBank survey, sentiment pulse survey, 91% of companies seem focused on managing tariff impacts, top priority, broad-based nature of potential impacts really seen through there. As we're just weeks away from the second quarter earnings season kicking off here, what are you anticipating? Is it more, hey, we still don't have clarity, so the macroeconomic backdrop is not going to support us actually giving more guidance, and thus you're going to have to wait until yet another quarter for us to solidify how you should be grading us? What are the anticipations?
I don't think companies show their hands here unless they're in desperate straits. And let's be honest, corporate America is never completely transparent about what's going on. They become very good at PR. Fair enough, right? Like you should be good at PR in the late 2020s. But looking into earnings season, I think the way that you wade through all of the words and all of the fancy commentary you get is by looking at earnings expectations. And that's what we saw in the first quarter. I mean, first quarter earnings were good, Brad, but we saw earnings expectations through Wall Street analysts get cut for the second, third, and fourth quarters. Some cuts, being fairly dramatic in certain sectors. So I would watch there. I would, again, listen to comments about tariffs. I think that there is some interesting color there, but don't expect companies to come out and say that, the year is a wash or, something could, break the year. I just don't think they're going to be that forthcoming.
Yeah, to your point, in 2025, there is way too much generative AI to be bad at PR. However, there's always an executive that finds a way. Callie, Stephen, thanks so much for taking the time here with us this morning. Oil prices easing this morning as investors monitor escalating attacks between Iran and Israel. So far, strikes have spared critical infrastructure and the vital Strait of Hormuz remains open. With more on what this backdrop could mean for U.S. policy, we've got Henrietta Treyz, who's the Veda Partners Managing Director and Managing Partner and Director of Economic Policy here. You're very important, and we want to make sure that we got the titles correct here. Henrietta, great to see you once again. Just take us into the significance of the events that have escalated over the weekend and your best anticipations for what we should be watching for next from this point.
Thanks for having me, Brad. My job is to translate how global events impact legislation in Capitol Hill and how that impacts investors. So first and foremost, the sanctions bill that senators had been very hopeful they'd be able to move sometime in the next couple of days is very much, I think, not on the table anymore. The White House has always pushed back on it pretty substantially, but the goal is to tie the president's hands and force him to take a tougher tone with Vladimir Putin. That's plainly not going to be something that they prioritize now, given Israel's actions in Iran, and as evidenced by the fact that the first person Trump called was Vladimir Putin to have him negotiate some sort of peace between Israel and Iran, which is going to be the topic of G7 discussions in Canada throughout this week. The second layer impact is that senators are going to deflect away from, say, deploying the National Guard and the Marines into California and away from the crackdown on mass deportations and the negative blowback that's had for the labor sector, specifically restaurants and farm workers, and try to get to the tax bill. So the tax package is on deck for this week. The senators are going to roll out their tax portion tonight at around 6 p.m. And that's where they'll train the next 3 days of their focus. They're only in session for 3 days, so they can't do too much damage.
And so with that in mind, what is the reality that as we're evaluating all of these moving parts on separate fronts and in separate regions, where do you think the priority for the administration is placing the focus right now?
It's really hard to say. I mean, there's so much going on. I think they are already deploying replenishing tankers and other aircraft out to Israel and going across the Atlantic right now. So they're plainly keeping an eye on that, prepared to jump in if necessary. But I think they really need to be worried about the market. Y'all were talking about the tariffs and corporate earnings coming up. Only 10% of corporations have updated their guidance based on the tariffs. So there's going to be a massive recalibration, I'm anticipating, as these tariffs both stay in effect and rise more than most people are anticipating. That's going to be sector specific with new Section 232 tariffs coming down the pike, as well as nation specific as we head into Liberation Day 2.0, as I'm calling it, or July 9th. Some countries are going to see their tariff rates rise. And that's going to be something that the market has to adjust to because that's not currently priced in.
You know, with that in mind, as we were taking a look at some fresh news this morning, it sounds like the EU could be weighing a 10% deal on the tariff front with that deadline in focus here. What is the probability that you believe that becomes reality as now this deadline is all the more closer and many countries are trying to figure out if they will really get a pause extension if they're shown to be negotiating in good faith, as Treasury Secretary Scott Bessent had just said last week?
Yeah, I mean, I think what we need to get used to, and this is what I told clients last week, is these tariffs are not coming off. So you might see a reduction in some rates. For example, Mexico is going to see the 50% tariff on steel and aluminum potentially go to 25% for certain above quota items. But with the EU, my fear has been that the EU tariffs will go into effect at their full 20% Liberation Day rate instead of staying at the 10% threshold. And if the best that they can anticipate and what constitutes a win to the EU is maintaining 10% tariffs, that is a permanent go-forward hit. And the reason I say the tariffs are going to rise is because that does not account for the Section 232 tariffs on steel, the other ones coming on lumber, copper, uranium, and a whole host of other items, including semiconductors, that are still coming down the pike before we even get into the Section 899 revenge tax and the new monetary policy authority granted to the Treasury Secretary on Ireland and Switzerland. So more tariffs, more taxes are coming.
You know, you mentioned steel, and of course, we can't have this conversation without talking about what was seen as one of the potential kind of pawns, or at least game pieces, within the broader deal-making moves here that we're seeing on the geopolitical front, and that is between Nippon Steel and, of course, the acquisition that was moving forward here between the U.S. Steel Corporation and Nippon Steel. The significance of that moving forward and this golden share from your evaluation.
Yeah, I mean, I think it's all about trying to generate headlines that appear as though there is domestic investment, regardless of what the president said on the campaign trail. Obviously, this is a complete about face, and authorizing this merger or acquisition to go into effect is something that I think the Steel Workers Union has been of mixed, at least public expression about, because they know they needed the investment. And Pittsburgh needs the investment. The entire state of Pennsylvania needs the investment. So that's what's coming. But it optically was such a problem during the campaign that you had to present as though you didn't support it. So now that that's moving forward, I think is in line with a lot of analysts' expectation.
Henrietta, always a great pleasure to get some of your insights on a range of topics here this morning. Thank you. Thanks for having me. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, we'll dive further into Nippon Steel's deal to buy U.S. Steel and that getting approval from President Trump. We've got the details next. Plus, we'll get a gauge on corporate America's appetite for deal making, that and much more on Morning Brief. Now time for some of today's trending tickers. We're watching U.S. chip makers, U.S. Steel, and Caring. Yahoo Finance's Josh Schaefer here to help me break them down. So let's set the scene here. First up, Taiwan broadly here, adding Chinese chip makers Huawei and SMIC to the country's trade blacklist here. The decision aligning Taiwan with U.S. trade interests and then also strengthening domestic chip makers. Taiwan Semiconductor, and the U.S.-based. The U.S. had banned those Chinese companies back in 2019. It's worth noting here. They're taking a look at some of the U.S.-based companies, NVIDIA, AMD, and Broadcom. They're holding on to gains here pre-market, though.
Yeah, Brad, I think that would be the initial read-through, right, as you take a look at a stock like AMD, NVIDIA, Broadcom, try and find some sort of, there should, in theory, be potentially a boost for those companies, right, as there's less overall competitors. Maybe it helps them a little bit. I mean, you're not seeing a big move in any of those stocks here, I think we should note, which sort of gives you a broad read-through on what does this exactly mean? I think it's perhaps maybe unclear, right, as far as how long would this ban hold? Yeah. How much does that actually matter for the large businesses that we were talking about here, for that to be in there? And I think just generally when you think about sort of the chip makers and their sales across seas, there's always a lot of back and forth, right, with kind of how that legislation works. And I think as an investor, it's hard to see something happen one day and then feel confident that that is going to be the stance going forward.
Well, these companies still being up pre-market also points back to the fact that none of them really baked in some massive move in Taiwan, knowing how much entrenchment that Taiwan Semiconductor already has in its own native country. Oh yeah, and the rest of the world for its chip fabrication process. And if anything, I think all of these companies are trying to figure out, as Jensen Huang was talking about in recent weeks, I think at VivaTech, he acknowledged, hey, this is a $15 billion opportunity that we've missed out on to this point. So only think about what that could grow into over the next several years if we're able to create better relationships within China.
And it's interesting too, just given the trade war, to think about Taiwan taking a familiar stance to how the U.S. is setting global policy, right? Perhaps maybe a subtle win for the U.S. in terms of some of these negotiations that are going on.
Absolutely. Next up here, we're tracking President Trump approving Nippon Steel's nearly $15 billion merger with U.S. Steel. This after the company signed a national security agreement giving the U.S. government a golden share. President Biden originally blocked the deal during his final days in office, citing national security concerns. And this was actually, as our guest from Veda Partners, Henrietta Trey's, was reminding us, this is an about-face from the now Trump administration versus what they campaigned on coming into office.
Yeah, I think just thinking about an M&A deal under the Trump administration, right? Remember, if you go back 6 months, that was one of the key pillars of the so-called Trump trade, right? Was all of these M&A deals, deregulation, there's going to be more companies coming public. Yeah. And you have started to see that IPO meter check a little bit over the last couple weeks, right? IPOs have had a pretty good run now for about a month and a half. And as you get into the back half of this year, post some of the tariff discussion, are we going to get the other positive parts of Trump policy that investors had been excited about 6 months ago, M&A being one of them? Just one deal here, and given that it is in the steel industry, I think there's maybe perhaps a different read-through on what exactly is going on here, and I'm not saying that it's opening up the M&A window by any means, but I do think that's a key pillar to continue to watch as we get into the back half of this year, sort of what happens with that trend, and if it is one of the things that can help continue to boost the equity market as we get in the last 6 months.
Yeah, EY Parthenon Deal Barometer for U.S. Economic Outlook forecasting a very slight rise in total U.S. deal volume in 2025 for deals over $100 million. Just lastly, and we'll sprint to the finish on this one, carrying the parent company of Gucci, eyeing a new CEO here, according to a report from Bloomberg. The French fashion house expected to appoint outgoing Renault CEO Luca De Meo as its new leader, hoping that he can help turn the company around. I don't know, perhaps there's some overlap in high value, high cost consumers. We were kind of struggling, at least as we were discussing.
Yeah, luxury world, I guess, right?
Yeah,
but
sure.
I mean, I think just thinking about the move in general, you don't have to look past the stock price here, right? This stock is down 36% over the last year. You zoom out over 5 years, it's down 61%. Yeah. Clearly, there hasn't been the demand for those used to be popular Gucci belts, Brad, and they need to find a way to just reinvigorate demand, right? And do something a little bit different from a strategy standpoint. So that seems to be the overall move.
The replenishment rate on the Gucci belts has got to be low right now. Thanks so much, Josh. Appreciate it. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, we've got the opening bell on Wall Street when Morning Brief returns. There you're taking a look at the opening bells at the New York Stock Exchange, where Accurate rings the opening bell. And at the NASDAQ, where you've got Lincoln Tech ringing the opening bell, beginning today's trading activity. They pressed the button. They got some funfetti. I don't make the rules. That's just how it works. Taking a look at how the major averages open up here on the day. If we could take a look there, hey, no, we've got the Yahoo Finance Interactive, Wi-Fi Interactive dialed in as we're seeing fractional gains at the gate here right now. 0.5% for the Dow Jones Industrial Average, a little more than 0.5% for the S&P 500 and the NASDAQ Composite. You're also seeing that to the upside as of right now, 0.9%. Investors seem to be, at least in the early moments of today's trade, shrugging off some of the conflict that we're watching very closely play out in the Middle East right now. Of course, there was the shock that took place Friday that hit markets a little bit, and now we're continuing to watch to see where there's a little bit of the return into some certain trades, very specific trades. And so let's dive into the 11 S&P 500 sectors here. We got the heat map fired up for you here. And as we were seeing gains across the board for the major averages here, everywhere except for energy as of right now. Energy is down by about 0.3%. You're also seeing XLK technology, though, on the other side of that spectrum. It's leading the pack here today as 10 of 11 of the S&P 500 sectors are in positive territory. Since we were mentioning technology, let's blind you with some science here for a hot second. As we're checking in on the mega cap tech stocks and specifically those Mag 7 names, all the Mag 7 names look to be in positive territory. We've got NVIDIA right now moving higher, powering up by about 1.4% here. You've also got 1.5% in gains at the gate for Tesla this morning at the opening bell, and also Meta Platforms catching a bid for all of you who are scrolling feverishly on your phones right now. You're seeing that up by about 2.8% for Meta. And then just lastly, I'll take a look at the Dow 30 components out the gate. We've got a few areas of red peppered into the mix right now. Put this on an equal view so you can see the biggest gainer and the biggest laggard. Biggest gainer right now, off into the races, you've got the swoosh. It's up by about 2% on the day here. And then additionally, in the back of the class, you've got United Health, UNH shares, begin the day lower by about 1%. It is time now for today's strategy session. Wells Fargo's Investment Institute releasing its 2025 mid-year outlook with insight and guidance for investors. Joining me now, we've got Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. Veronica, great to see you. Thanks so much for hopping on after the opening bell. Walk us through some of the key takeaways from that report.
Yeah, absolutely. One major key takeaway in our outlook is that through 2026, we're expecting stock market to move higher. There's going to be some volatility this year. There are a lot of economic, geopolitical, and policy uncertainties that are going to contribute to some market volatility this year. When we think through 2026, as the economy growth reaccelerates, we are going to see those higher stock prices. And so we're really focused on keeping investors invested in the market at this point.
And so with that in mind, one of the notes that I was looking at is your views and how you're evaluating this entire outlook across periods of volatility that are being expected here. You mentioned within this outlook, viewing further periods of volatility as an opportunity to lean into equities to position for the gains that you expect through 2026. What does that mean in terms of an asset class that you would be looking to and kind of over-indexing towards?
That's right. So we want to be selective in that equity space, and we're focusing on quality. So we like the large cap and the mid cap space over small caps, and we like developed markets over emerging markets. So thinking about moving a little bit up in quality, not over risking within the equity space. So on those down days when the market pulls back, that's where we want to add exposure, the US large cap space and the mid cap space. And then if you're underweight in an international space, adding to developed over adding to emerging markets.
You know, we had one of our guests earlier from Ritz-Holtz Wealth, Callie Cox, who had said that a lot of executives may not need to actually come out swinging and say, hey, everything is now fine, when in fact, everything is not very much fine. Tariff trouble, as you note within your own outlook as well, that's still going to persist. And so with that persistence, what is the likelihood that in this next earnings season to begin in a couple weeks, that we actually have even more or any type of clarity from a C-suite across corporate America that is trying to best figure out, okay, how long could this linger and be a headwind to our own results?
Yeah, I think we're likely to see another earnings quarter where companies are reiterating caution or a lot of uncertainty still related to tariffs. I think with the rebound from the April lows with the market, we might have been lulled into a false sense of security around the tariffs. But the fact remains that a lot of things are still unsettled. We've got that, mid-July deadline for, re-implementation of some tariffs. Potentially, we might see some trade deals between now and then. But the fact remains that that's still an uncertainty. And so we could, at the start of this, Q2 earnings season, start to see some companies still a little bit uncertain, not quite knowing what to do with forward guidance.
And so as I'm looking through some of the top 5 things that you're looking for and top 5 portfolio ideas for the balance of 2025, one of the things that jumped out to me was how you're looking across some of not just the policy uncertainty, but then also trying to figure out where within this diversification strategy investors could potentially see some outperformance. And we had actually a viewer that commented to one of our conversations last week on Twitter saying, where have there been surprising elements of resilience even in the diversification strategy right now? Where have you been seeing that?
Yeah, I think what we've been seeing is a bit of strength in the international space. So far this year, developed markets, ex-US equities have really picked up the slack where other equity markets have, disappointed. We haven't fully recovered from that pullback in the US markets. And so had you had that developed market exposure as a part of a globally diversified allocation, would have helped a lot during that pullback that we saw earlier this year. We are continuing to expect some volatility that's going to be pretty much US centric. And so continuing to have that developed market exposure is a good idea for this year.
And what do you expect of the long tail of the generative AI trade to look like in all of that?
Yeah, we think with AI, it's been thought of as only a tech story, but we think that there are some other sectors that are really going to benefit from the AI space. So communication services in particular, industrials and energy, we think are all other sectors that are going to benefit really well. Those companies are going to be able to, utilize AI, or they're, a part of the supply chain for providing the energy necessary for generative AI. And so we think, don't just focus on the tech sector, which we are still favorable on, but broadening that out into some of these other sectors is going to be a really good way to play the AI trade.
Veronica, always great to grab some time and insights from you. Thank you.
Thank you.
Let's get to the 3 market movers that you need to watch for the trading day. Yahoo Finance's Jared Blickery has more.
Thank you, Brad. We are watching stocks in rally mode, and if you drill down into the market, I'm noticing that tech, both big and small, both of those are popping right now. And then if you look at commodities, we have a mixed board, so I'll go into some of those details in a minute. But first, let's take a look at the S&P 500. It is up 74 basis points. That's 0.75% here. And I'm just going to put on a trailing 1-month chart. I've been showing the year-to-date a lot, and we are within 2-3% of record highs still. And you can see we're not quite at the highest levels over the trailing month, but well off of these lows that we saw in the latter half of May. And if you take a look at the S&P 600, this is doing even better right now. And I've been talking about small caps. You have the Russell 2000 and the S&P 600. That is getting a nice lift as well, up 80 basis points. So a little bit more than the S&P 500. And let's take a look at volatility. Critically, volatility is still dropping. We had a little bit of a pop there on Friday with some more headline tariff scares, but that is now down. You can see that down below the 20 level right there once again. And let's take a look at the VVIX. Now, this is interesting. This is the VIX of the VIX, and I'm not going to go into all the wonky details here, but I will note that over the last 3 days, it has been heading higher. And this is kind of when you look at the VVIX versus the VIX action, and you see them going different ways, well, sometimes that needs to be resolved. And so this could be a little bit of a yellow flag, kind of the way that the VIX was sending a little bit of a yellow flag last Thursday. So I'm not entirely sure that we will see those record highs this week, and this is a holiday shortened week, but there you go. Now let's take a look inside the market here, and let's take a look at big tech first. And this is our large cap sector leader group. Financials and tech are now tied neck and neck, 1.07%. And if we drill down into the NASDAQ 100, we can see Meta and also Tesla. Actually, NVIDIA is leading right now. So Meta and NVIDIA are both leading. Meta up 2.33%. I'll give you a quick year-to-date on Meta, and you can see it's been in positive territory since early May, and it is up 20% right now. We know the NVIDIA story, and let me just put a one-year chart so we can see how close it is to those record highs. Much like the major indices, just kind of within spitting distance right there. I also said small tech is leading as well. This is my leaderboard, and up there in the upper left is ARK. Now the largest component is Tesla, which is a big stock, but other than that, if we take a look inside, we can see a number of smaller issues from Robinhood to Roblox to Roku, all of those jumping nicely. Roku up 10.3%. Here's the 1 year up 50%, well off of the highs from earlier this year, but nice to reclaim some of that territory. Now we're going to move over into the futures, and in the upper left is platinum. Now platinum has been very volatile, so it's been leading to the upside or the downside depending on which day it is. This is a 1 year chart, and you can see the breakout. I've been charting this quite a bit. There's that pop right there. But if I show you the 5-day, you can see there's been a lot of volatility. Late last week, we saw a big drop off. We did get the dollar popping a little bit, and there was some international headlines that contributed to that. But notice how quickly it has rebounded off of those lows. So we might see higher highs ahead. Also, silver jumping just a little bit, but I'm going to move on to gold. Gold is down about 0.2%. It's just really been consolidating over the last month or so. Here's the year to date. Let me show that a little bit better. And you can see wants to look like it's trying to reclaim some highs there, but on an intraday basis, I don't think it's there just yet, but very close to that $3,500 level. So we're going to be watching that in gold for any kind of a breakout, just giving a little bit back today. Finally, crude oil. That is down 1%. And after those international geopolitical headlines that we saw on Friday with respect to Iran and Israel, that airstrike, that is now down 1%. But we hit as high as in the upper 70s. And so this is a market you want to follow. A lot of times when you get geopolitical shocks, it's a one-off event. And that might be the case right now. But things heat up again, of course, that could reverse. And crude oil is a market you want to watch for that. On that note, I will send it back to you, Brad.
Jared, thank you. Setting up today's trading activity. Coming up, corporate America's read on the Trump economy. We'll speak on that next. President Trump's Liberation Day tariff pause set to expire in less than a month, with just one official trade deal on the books. And monthly M&A, mergers and acquisitions, fell in April, with just 73 deals signed in the month, a decline of 30% year over year. Are corporate America's leaders still confident in the president's plans for the economy? I want to bring in a good friend of the show, Scott Sperling, THL Partners co-CEO. Scott, good to grab some time with you here this morning. You know, as we begin, let's just think about first the tariff side and the expiration of this pause period. We're now getting some modeling that's coming out of major institutions, perhaps your firm as well, trying to gauge what the effective tariff rate, the average effective tariff rate, and JP Morgan, their research says it should settle around 15 to 18%. What would the long-term impact of anything within that range look like for corporate executives in business?
Sure. I think if we knew with certainty that that was the range, and I think we all expected it to be at least 10%, given the president's stated intention to generate revenue that is sustainable from tariffs, that there would be some base level that was well beyond what we were used to. So I think something in the 10% range was expected. If it's in the 15 to 18% range, where it's tilted in ways that there are other political and national security interests that are involved, so that the base on most of our allied trading partners is more in the 10% range. That's something that I think we can all work with. It's the uncertainties that I think are most problematic for the market and most problematic in some ways for looking at the kinds of things that we look at in private equity. But I do think that we're going to get to a period where we're going to have some level of certainty, and it will incorporate a base level. I think that will bring us back to more of a business as usual approach, both in the public markets and in the private markets, and something that can be adjusted for.
What we've continued to hear from the administration is that the tariffs will pay for the tax cuts. And If that were the case, that would also mean both on the cuts front for individuals and households that they're looking for, there is the mindset of the tariffs paying off some of the benefits that they may see, while at the same time, there's the consideration that for what has already been estimated for the additive and the cost of how this could increase the deficit over many years, how would corporate executives like to see ultimately the tariffs be utilized but not be egregious to net out better deals, and then ultimately how they're able to benefit for larger businesses that then could absolutely be an economic boost if done correctly?
Yes, I think you actually gave the answer in your question, which is one of the major concerns I think many of us have is runaway deficits that result in national debt refinancing that is not controllable, where the supply-demand dynamic of that becomes very negative, and therefore even the Fed has minimal control over long-term rates. I think that is one of the great longer-term fears, or midterm fear, if you will, that many have. If we can have this source of revenue that can offset the potential for incremental deficits, I think that would be a net positive for the marketplace. There's still obviously a whole slew of uncertainties that we still have to deal with. Geopolitical, which the market seems to be desensitized to, is one thing. The impact of generative AI, which I think will be a net enormous positive for our economy, in that it will increase productivity across a whole slew of businesses and industries, will also be disruptive in ways that are not certain to a wide range of businesses, some of which have been very favored business models, like the software business. Others are more service-oriented industries, accounting, legal, other forms of consulting that may be adversely affected by the benefit that generative AI can bring. So there is already a whole set of underlying uncertainties that we will be dealing with. If we can bring a little bit more certainty to the tariff side and the deficit side, I think that would be a net plus.
Scott, we had teased deal making and that you and I would discuss that. So let's go there, because we see a lot of the projections around what deal making could look like. And we had seen that coming into the Trump 2.0 administration, as It's been dubbed. How are the expectations living up at this juncture? As it seems like the technology sector is really the sector that's driving that deal making value so far this year.
I think that's not only true, but it has been true for quite a while. And much of it is the nature of the business model of many of these technology companies, where you have strong recurring revenue streams, or at least reoccurring revenue streams that are highly predictable. And one of the questions is whether or not the valuation multiples that are now being paid for these business models make sense. But the business model itself is one that has proven to be incredibly attractive. And if you're a corporate buyer, a strategic buyer, where you're looking at 20, 30, 40 years down the road, it makes sense at a wide range of prices. If you're a financial buyer and you're looking at a 5 to 7 year traditional hold period, sometimes even shorter, then looking at those valuation metrics very carefully is incredibly important. And one of the things that we had hoped for going into this year is that you would see an opening of a significant supply of companies, particularly coming from other financial players. That hasn't quite happened, given the uncertainties the market has had and the fact that the valuation metrics have been down in the public markets for many of those kinds of companies, not allowing the private equity players to achieve the kinds of returns on particularly the companies they bought at the height of multiples in 21 and early 22.
So this one trend is emerging for sure, and I believe it was flagged by EY Parthenon, strategic divestment actually unlocking value for some companies, and where private equity is also focusing on buying specific parts of business that they believe that they can bring under their own umbrella and make sure that there's kind of a prioritized focus on one element of a business that might have multiple segments that it's looking to perhaps even make sure that they have some liquidity or just some capital that comes in this interim period.
That is absolutely, that's absolutely true. There's a long history of private equity buying divested businesses from corporations, often businesses that did not get the kind of attention that we can bring to it. That has been enhanced by the fact that many firms, I know for ours, we have an enormous operating expertise that is resident within our firm that we can bring to bear on these kinds of companies to help improve their key business processes in ways that can accelerate revenue growth and improve the efficiency of the business model, generating higher levels of productivity. I think that's a trend in the industry, private equity industry, to in some way have some of that capability. That enhances our ability to buy these divested assets and drive the kind of returns that the investors in private equity have long received and are continuing to look for.
Scott, always a great pleasure to grab some time with you.
Great.
Thank you so much.
Thank you. Take care now.
You too. Coming up, the Trump administration and the Trump organization entering the phone business here. We'll bring you the details next on Morning Brief. The Trump organization launching a mobile network to rival major telecom providers and calling it Trump Mobile. The company saying that the venture will have call centers based in the U.S. and phones made in America. The flagship 47 phone plan will cost $47.45 a month and includes 5G service, unlimited talk, text, and data, roadside assistance, telehealth services, and more. Customers can also sign up to pre-order the $499 T1 smartphone, which will be available in September, according to the website. The phone will be gold with T1 and an American flag etched into the back. The entity that manages President Trump's trademarks filing applications to the U.S. Patent and Trademark Office on Thursday to use his name and the term T1 for telecom-related services. The filings cover mobile phones, accessories, wireless telephone services, and even retail stores. With this venture, the Trump family enters a saturated smartphone market dominated by Apple and Samsung, with plans to make phones in the U.S. despite a lack of smartphone production infrastructure. Wedbush's Dan Ives previously estimated that an iPhone made in the U.S. could cost at least 25% more at $3,500 based on the labor costs alone. Checking in on shares of another Trump venture, DJT, they are slightly lower today. We'll keep you updated on this story as it progresses. That does it for the Morning Brief. Join me in the next hour for more analysis on catalysts coming up.